Hello. All right. I need to learn how to simulcast because right now I'm alternating between TikTok and Instagram. What I like about TikTok actually is the videos are pretty easy to just start doing lives. I started lives there, but Instagram has all these features where you can sort of put up information, which I really like. Look at that. I'm going to start off with that information. So what we're looking at here actually is the inventory change in some of the large cities in America. So everything looks relatively normal except for San Francisco. Inventory just exploded in San Francisco for sale. So a lot of homes available in San Francisco not getting sold, which is crazy. Hey guys, this is another good graph too. So this is what happens to people. Hey Serge, doing good. You're not working and doing this at work, are you? So this graph is interesting. Where do you find these figures? Well, I read a lot, and then if I like a picture, I sort of take a pic. I guess I screen grab it. I read like a whole bunch of stuff. It's hard for me to know, like CNBC and Financial Times and Bloomberg. So wherever I get it. Also, this one might be from one of the what do you call it? Blogs somewhere. Anyway, so this is looking at whether or not you should jump in and out of the market. So a lot of times when I talk to people, they're like, "Oh, I'm not sure I should invest in the stock market because I'm scared of a crash." And oh my goodness, I think a crash is coming, I'm going to sell, I'm going to jump in and out. This is the reason why you should not jump in and out, okay? Because a lot of times some people sell out of an index, like a low-fee US, and they sell, and the crash happens. So a lot of people sold in March, and they're like, oh, I got out just in time. And then they don't get back in. So it's not the selling that's the problem. Like you could sell at the right time before a crash. The problem is that to be successful, you actually need to buy back in. That's the second part that people forget that you need to do. Because when you sell, you're in cash. And cash is trash. So you need to get back in, and you don't know when to get back in. How do you know when to get back in? Because every time you're selling, you're scared. And when you're scared, it looks like it's going to get worse all the time. And over here you can see, if you just stayed invested, you would have followed the black line. But if you sold out and you missed the best days, you basically had no return. Like your return was similar to a treasury, US treasury, which is like ridiculous. Anyway, so you can see here, there's this guy, he posted, he was like, oh, I'm so scared, you know, the black swan is here. This is a virus crisis post from Bogleheads, whatever. And this person was like, I'm so scared, I'm selling. And they sold right in March 20th. And you can see they sold literally at the bottom, like right there they sold. And then the market went straight up and they missed all of it. So they were literally the same person who had this type of return because they missed the best time to invest. So that's really sucky, right? Another person here, I want to share that I just pulled the trigger and I went completely into bonds on March 20th. Do you see that date? March 20th? So they completely jumped out of the stock market because they were scared. You know, it's like, oh, I'm so scared. I don't know what's going to happen. My gut says it's really bad. Pulled the trigger, went into non-stocks on March 20th. That's almost the bottom. And literally a week later, after doing that, they missed out on the entire 40% gain since then. Like, it's ridiculous. Would you convert Canadian to US dollar for investment purposes even with the horrible exchange rate? That's a really good question. I did. So when I started in the 90s, let me get rid of this picture. How do I get rid of pictures? Oh yeah, this way. When I started in the 90s, the Canadian dollar was worth 66 cents US. And yes, I bought US stocks at conversion rates worse than today. So yeah, I did that because, again, you have to understand where your source of information comes from. So my source of information, like if you're listening to me, so I'll tell people who are watching me now for the first time what type of information you can expect from me. Pro-US, I want to own US assets and US currency. I understand that over time, currency fluctuates. There are going to be periods where the Canadian dollar is equal or stronger than the American dollar, and all my American assets will devalue relative to the Canadian dollar. However, in the long term, I believe having US dollars and US assets will benefit me more than having Canadian dollars or Canadian assets right now. That might change, right? If Canada goes into a huge economic slump and assets come for sale, it might swing the other way. But as of right now, you're talking to someone who is pro-US economy and production, pro-US dollar, and pro-cash flow. So I'm not an appreciation investor, right? So if you're talking about should I buy a property in Toronto and stuff like that, or should I buy it in New York, that's not me. I look for cash flow because I need cash flow to cover my living expenses so I don't need to work, right? Now let's say you're someone who's like someone who loves to work. Like you have a great job, you're a lawyer, or you're a teacher, or you're a firefighter, you love working, then that's not, part of my information will be useful, but not all of it, because I'm the person who doesn't want to work. I do not want to work. I don't want to have a job. I want to have income, or I want to go on a path where I have income to cover my living expenses, so a job is optional. I'll put it that way. Not I don't like to work. The job is optional. Like a job became optional for me in my 40s. And at that point I decided, I did work for a while when I didn't need to. And eventually I said, why am I doing this? And I stopped. But some people love their job. Like I have a friend who's also very wealthy, but he loves working. He's a Bay Street banker. He's a trader. He loves it. Like he feels alive trading for one of the big banks. That's fine. That's what he wants. Okay, so the best way to ask questions, I think, is to get one of these things to light up and let me know, because it's hard to scroll. How do you handle healthcare? Yeah, I live in Canada, FYI. I was born and raised in Canada. I love Canada. So don't get me wrong. A lot of people are like, oh, you invest everything in the US, so you must hate Canada. No, I love Canada. Canada is the best in terms of, it's not getting better, but Canada is better in terms of income inequality. We take care of the poor very well. Healthcare is fantastic. I have no problems with the crime, the people. I love the people. The school system is supposedly better. I mean, I have some relatives in California. They tell me how their school system works, and it seems like a lot different. We have a lot of resources, libraries, and I just love living here. It's fantastic. But in terms of investments, I'll tell you one thing. As a Canadian, when you have US cash coming in or US assets, it makes living in Canada a lot more inexpensive. Let's put it that way. Like when you have US dollars and you go around Canada looking at the Canadian prices, it's like, oh, it's actually 30% cheaper with these American dollars that I have. So that's why I like America. Now let's talk about real estate here. So real estate, some people, when they watch my videos, they're like, why aren't you against home ownership? Okay, so I'm not against home ownership. 30%. Yes, 30%. It's like discounted by 30%. So home ownership, I don't mind home ownership, okay? So I'm not against home ownership. because this is why I had the book, right? So people don't understand what a home is, right? So the problem comes when people start debating each other about home ownership and they don't know what a home is. And they start saying, well, it's a better investment because it does this and I can live in it too. A home is not an investment. Okay? There's no home that's an investment. It's an expense, right? So you can't compare an expense to an investment. Of course, it appreciates, so we can talk about what type of asset appreciates but generates expenses. Those are called non-productive assets. Okay, so I'm going to double back. Let me answer these questions first. What was the worst percentage of return in the S&P historically? The worst? I don't know. I haven't lived in the Great Depression. I think the Great Depression probably had the worst. But what I've experienced as the worst was the credit crisis when it went below 50%. Like my stocks went down by over 50%, half. So watching your investments get cut in half, that's an experience, I'll tell you that. Because the way I structure my investments with a storage fund, my storage fund is used to take advantage of those type of opportunities. So I bought into that maelstrom, right? Most people cannot. Like, I don't want to make it sound like it's so easy to do that, because even when the virus crisis and the market went down like really quickly, a lot of people had a problem doing that. You can see here, for example, when I was reading this message board, this message board here, you can see here on March the 20th, this guy sold everything because they were scared. And this was just a downturn that was lasting maybe a few months. Like, it wasn't even that long. I mean, the virus crisis hit, the stock market went down, and then went right back up again. It literally looked like this. This person sold out at the bottom when the market looked like that, right? So the market went down for, I don't know how long that is. That looks like a month or so. And then they sold out. So it is a very difficult thing to actually buy in a downturn. So when I talk about a storage fund, and I'm going to talk a bit about risk, right? When I talk about a storage fund, it is completely optional. If you just have an emergency fund, right, and you have your growth account, and all you did was contribute regularly and shut off the media, like you shut off the radio, shut off the computer, don't listen to podcasts, don't watch the news, you just invested regularly, you'll wake up one day 30 years older and you'll have a lot of money. If you could do that, you're set, right? I'm a bit of a sadist. I like buying into downturns. Like, I bought into the .com crash. I bought into the credit crisis, the housing crash. Like, I like that. That gets me charged up. Like, I feel really alive when I do that. But if you know you don't like volatility, if you know that when the market goes down by 10, 20, 30% and you don't like it, you shouldn't look at it. What you should do is what John Bogle said. Ignore everything. Invest regularly. Don't look at your bank statements. Don't look at unless you're about to retire, don't look at anything. Invest regularly, stock up your emergency fund, do what you love, like for your job or for your career, and then wake up in 30 years and you'll be fine. You're done. You've contributed like regularly, like $500 a month or whatever a month. You'll be fine, right? I'll tell you one thing. When you talk to a financial guru or invest planner, they always talk about risk, right? I've listened to enough of these people where they talk about risk. They're not talking about risk. They're talking about volatility. So I've sat there because I have to take care of my parents' finances, right? My parents are very like basic investors, like, GIC ladders, CD ladders, that kind of stuff. So when I sit there listening to their financial advisor, when they're talking about risk, they're not talking about risk. They're talking about volatility. So they'll say like, oh, it's very volatile and the price goes down. So let's get something straight. Risk may be a function of asset class. Maybe. It may be associated with a bond, a stock, or real estate. But from my experience and my perspective, risk is more associated with, number one, temperament, right? Whether or not you can get scared. If you get scared really easy, you're a high risk, right? It's sort of like When they say you're a certain age, you're a higher risk for this, heart disease or whatever, that's like this. If you have a temperament that gets nervous when the market goes down, like you can only tolerate up, you are at risk of selling. You are at higher risk of doing something stupid that you shouldn't be doing. So temperament's number one. Risk is also a function of price, not in the way you think. Most people, like the financial planners, are like, oh, it gets risky when the market crashes. That's the opposite. When prices get low, it doesn't get riskier. It gets risk less. The risk drops. For example, a very simple example, real estate in Phoenix that I was buying, when a house goes from $200,000 or $250,000 and it goes down to 60, do I have less risk or more risk? Is it more risky to buy a house at $60,000 or $250,000? For me, it's pretty simple. It's almost no risk for me to buy a house at 50 grand, at 60 grand. Like it's less than a car. So a function of price, temperament, and the third thing is knowledge. Knowledge, okay? So let's say you have the temperament down. Like you have an emotional will of steel, right? You don't get shaken out when the price goes down. Let's say that the price does go down, so the risk has dropped. But now you don't have knowledge. So you go into an asset class like real estate or stocks. If you don't have knowledge, like awareness of what's happening, that's high risk. That's very high risk because you don't know what's going on. However, having said that, let's say you knew nothing about real estate, nothing. But you knew the prices were down by 70%, like the housing crisis, and you had a will of steel. That's almost enough to compensate for ignorance. You could be buying properties like galore, and despite your lack of knowledge, you'll be making a ton of money. But knowledge is still important. I wouldn't do it that way personally, but the risk for me is driven by knowledge, temperament, and price. But when you talk to 99% of financial advisors or planners, risk is associated with price movement, like volatility, which to me doesn't make any sense. Makes no sense whatsoever. But when you talk to people who are very wealthy, they'll understand what you're talking about. They'll say like, yeah, volatility is irrelevant. The virus crisis, continue investing regular, yeah. So the 3-bucket system that I use, you don't need all three. Okay, let's put it that way, number one. So the 3-bucket system, for those who are not familiar, I set up a system where I could work my way. I could work like I was working after I graduated from school. I would work and I would make my way towards financial freedom. So my goal, and this is different for different people, right? Some people love their job. If you love your job, I would say all you need is the growth and emergency fund, and you can forget the rest. Do what you love in terms of your job. If you love your job, if you love being a teacher, a firefighter, whatnot, do that. But have the growth fund and the emergency fund and keep going. But I wanted to get out, right? So I wanted to not work. So that's why I had the 3rd bucket, the storage fund. So how do they work? Let's say I started all over again, age of 18. No money, but I can contribute $300 a month. All right, let's start from there. I would put 100 into my emergency fund, 100 into my storage fund, and 100 into my growth fund or bucket. So the growth bucket would be for a low-fee US index. That would grow. That would be something I put in regularly and I'd forget about it. My emergency fund is for inevitable life problems. You will have life problems, okay? Death in the family, health issues, fender bender, job loss. Something's gonna come up, inevitably. So I would put 100 a month into that bucket until I have 12 months of living expenses. Don't expect everyone to fill up all these buckets right away, but you wanna move towards that. So once I get to 12 months, and some people stop at 6, that's fine. At least you have that in your radar, right? 12 months, that bucket caps out and it sits there. I don't touch it. I don't consider it part of my asset allocation. I don't consider that as part of my investable assets. The emergency fund is for emergencies. It is in an easily accessible, highly liquid, low risk investment, like, not even investment, low risk vehicle, like a CD, certificate of deposit, a guaranteed investment certificate in Canada, GIC, a high interest savings account, easily liquid, pre-encashable, whatever. Right? That's for problems. And everyone's going to have a problem. I mean, I've had enough problems, right? So that caps out. The growth fund never caps out. It just keeps going. The only time it caps out is when, I don't even know when that would cap out. I guess when you want the money. Maybe when you retire, something like that. But the way I invest, I'll never need it. Right? My growth fund will continue to grow and I won't need it because I have cash flow. So that comes from the storage bucket. So if my goal is to work towards not working, then the storage bucket comes into play, right? Like I said again, and I'm going to make this very clear. If you love your job and you love what you do, which is fine. Like I know someone, like I said before, Bay Street trader, loves what he does. He just has his growth fund and his emergency fund. That's all he's got. Because he wants to keep working forever, right? Because he loves it. He gets a charge out of it. So the emergency fund is if he has problems with his health, which he's had. And the growth fund is for when he decides to retire or they force him out. The storage fund is for people like me who don't want to work. I eventually want to not work. The storage fund is to take advantage of opportunities that can provide me with cash flow to pay for all my living expenses, right? So the storage fund invests in things where I see cash flow and I can say, wow, I can get an extra, $1,000 here that pays for my groceries, an extra $1,000 there that pays for my internet and whatever, and then I keep building up that cash flow until it pays for everything. And at that point, I can transition from working, where working becomes optional. How about that? Optional. Not like you quit working or never work again. Like it becomes like if I decide after 5 years from now, I said I want to go back to work. All right, I can go back to work. It's very difficult to do that. I'll tell you that right now. Once you leave work, and it's not because of the skills. It's because when you work, you get paid, right? But the money, you don't even use the money. So after a while, it feels kind of pointless. It feels like really, what am I doing? Sorry, 10 minutes ago, Starbucks. Any advice on rental properties in Canada, cities to consider? Yeah, that's the thing, Diego. That's a good observation. And what I say all the time, but everyone gets upset when I say that, as if I'm like a heretic or something. Anyway, so rental properties in Canada. I know people are purchasing property in Alberta. I'm not personally, but I know people they're buying regular properties in Alberta. Where in Alberta? I don't know. Let me put up this thing, because this is what, I always put this up anyway. People just don't understand how important it is. People just don't understand. Like, for example, when you look at this graph, I don't know why people get upset, but every time I say, listen, there's no reason to sell because the stock market always recovers. The U.S. market always recovers. It's never different this time. Stay the course. And then people get upset. Like, well, what about Japan? And what happens if look at the Roman Empire? I was like, let's be honest. If America blows up, you have bigger problems than not having enough money in your 401k or RSP. You're gonna have big problems. We're all gonna have big problems. And if you look at that line for the stock, right? I mean, think about all the stuff that America has gone through since 1802, right? They've gone through like everything. They've gone through wars, like Korean War, the oil embargo, the Cold War, world wars. Like the entire world was at war. They've gone through like credit freezes and giant, enormous problems, and they've survived. Will they survive forever? Nothing lasts forever. So yeah, it's possible. The American empire, just like all previous empires, come to an end. But if that happens, you're not when the empire comes to an end, you're not going to be worried about your 401k and RSP. I'll tell you that. So, on the larger opportunity where you're not, where the entire planet won't blow up, you're probably better to just stay invested. Okay, so this map is for real estate. I'm going to talk a bit more about real estate today. I'm just going to talk a bit more about that because last time I spoke a lot on stocks. So real estate, you can see this map. It's horrible for an investor, right? So if you look at each circle there represents a county in the States that is of a certain size and population. And each circle represents a county, and the color represents the yield, the gross rental yield of property in that county. And 10 years ago, this map was bright green. Like literally, except for a few cities on the coast, this map was neon green 10 years ago. 10 to 12 years ago. Now it's gone the opposite way. It is blood red, which basically means that the rental yields are bad. Like you can see how low that is, right? What is that? That's like a 1 or 2% above inflation. So you can invest in rental property unless you're able to find a deal in your area. You're going to be taking a lot of risk to purchase something that yields a little over inflation and maybe a little more than that when you lever it up. So yeah, real estate in America is tough. There's some green places here. So you can actually go here, Atom, you can see the bottom there, Atom's Data Solutions. You can go and play around with this map. Atom Data Solutions, like that. Atom Data, literally search for that title. Search for that title. You will pull up that article with the interactive map. You can play around with it. It shows you the median income, the median house price, the population, the average house price, all bit. You can see what counties actually are not expensive. Play around with it. Right now, off the top of my head, the places that have tolerable rental yields are Mobile, Alabama, Baltimore, Harris County, Detroit, Arkansas, Little Rock, Arkansas, those type of places. Some of them you'd consider tertiary markets. So in the past, when this was all green 10 years ago, primary markets like Miami, I was in Miami looking at property, in Phoenix, Los Angeles, they were all like bright green. You can buy almost anything, anytime, anywhere, no competition. Nobody was bidding against you. You can buy beautiful homes, condos, multifamilies for nothing. Let's see, a question here. What areas of the U.S. are your investment properties? That's a fantastic question. So my properties are located, I don't know how well you know the map, but I'm located in Arizona. So a few cities in Arizona, Phoenix, Tolleson, Surprise. Those are small suburbs in Phoenix and also Phoenix proper. I'm also invested in Tennessee, so Bartlett, Memphis, which are other cities near Memphis. And I was thinking of investing in Arkansas, but I haven't yet. So right now, those are the places that I'm invested in. Are they good now? No, they're not, right? They've been mined out, as you want to put it. Very difficult to find product that makes sense in Memphis and the surrounding suburbs. It's very difficult to find product that's... So I bid... Okay, let's go through the process of investing remotely. Because let me tell you, I'll show you this book. Let's don't focus on the face. All right, so this is Commercial Real Estate Investing by a person called David Lindahl. So David Lindahl, I'm going to type the name there. Actually, you can probably see it. So David Lindahl. This is actually the person who wrote the book, right? So that's the author you're looking for. You can ignore the president's face there because he's just using the president's face at that time to market the book. So David Lindahl is the commercial real estate guru of the 80s and 90s. He started off in a one-bedroom condo and he built up a holding of thousands of apartment buildings. And David, let me see, David actually will invest alongside you, but the catch is you have to find the deal. All right? So, but that's beside the point. So this is how I learned how to invest remotely. So David wrote this book and he explained, he says, listen, the best deals for real estate will not be around your house. It just won't happen. It's very unlikely unless you live in a small town or you know the market ungodly well and you don't have a job because that's all you're doing is real estate. You won't be able to find deals around your house. The deals will be somewhere else. So you need, if you want any chance whatsoever, or if you want any opportunity to do well in real estate, you got to get comfortable managing things remotely. And you would want to manage things remotely because why would you want to do work? Like when I invest, I am not looking to buy investments that I need to take care of. That just is so counterintuitive to an investment. An investment should take care of me. An investment that doesn't take care of me, and if investment is a burden on me, that's not an investment. Like I don't know what that is. An investment needs to take care of me. So the real estate that's going to take care of me or of an investor won't necessarily be in a 3 to 4 hour radius around where I live. Definitely not around Toronto, 100%. I can probably go like a 6 hour radius and I won't find anything. So this got me, David is a fantastic mentor, writer, and knowledge about real estate. And so you need to just get used to investing remotely. So having said that, so I go over in my book what kind of criteria you need to actually invest remotely to actually have it carry you. You overpay. A lot of people are like, oh, it's so risky to invest when you're when you're out of state because it's so risky. It's only risky because you don't know what you're doing. You don't know what price to pay. You don't know how to deal with the boots on the ground, like the inspectors, the lawyers, the appraisers, the property management companies, the turnkey guys. You don't know what questions to ask them. You don't know how to double check. Like when I was looking remotely, everything was online. I can get all the information with a phone or with the internet. And as long as the numbers work, it'll support you. So, funny thing enough, so David Lindahl, I'll just show that book again. So this is the book. And the funny thing is that David will actually invest in you, but you have to find the deal. And you don't even need the money. He'll actually put up the money. But the deal that he wants you to find is insane. So here's his criteria. So you can't read that. I don't know how I can make it fit into the screen. Like it has to be in an emerging market. He's only interested in buildings that are over 150 units. Has to be 85% occupied. Debt coverage ratio of 1.6. Okay, I'm not going to go into debt cover all these things, but when you read my book, you'll know what the debt coverage ratio is, and 1.6 is insane. Like, what he's looking for is literally a unicorn. And I think the reason why he has criteria like this is because it's not, he basically set up something where if you actually hit this criteria, it's worth his time to look into it. Otherwise, it's not worth his time. And I totally get that, right? For myself, I would look at things that are a lot more flexible than this. But the idea is every real estate investor has very strict criteria that makes sense for them to see the cash flow that they're looking for. It's like, I don't need to look for 150 units, a cash flowing 150 unit apartment to make it worth my while, right? Like if you showed me like a 10 unit cash flowing building, I'll be interested because that would make a difference to me. But for Dave, like if I showed him, or if anyone showed him a 10 unit cash flowing property, he'd be like, I don't care. Like it's like a pain in the ass, right? So it really depends on where you are. So for me, 10 units would be interesting to me if I could find a cash flowing at these numbers. But for Dave, it's not. But it just shows you everybody who's investing, the criteria becomes more strict the more money you have, right? Which is actually a bad thing in a way, because when you start investing, your criteria should be pretty strict, because unless your criteria are somewhat strict, you're not going to get out of the rat race, because it's not going to generate the cash flow that you need to see to start paying for your living expenses. You need a baseline cash flow to pay for your living expenses if you want to escape the rat race. Okay, so that's cash. So Ladan asked a question, are all the concepts in David Lindahl's book and John Bogle's book covered in my book? Yeah, that's a nice cheat, but no. So I'll tell you how the three books differ. Okay? So David Lindahl is focused primarily on multi-family apartments. That's it. If you want to learn how to invest in multi-family apartments, you should read that. But he also has gives a lot of advice on real estate investing, which was interesting to me at the time, right? So that's why I read the book. John Bogle's book is on index investing. Index investing, in my opinion, if you don't want to spend all your days studying annual statements, like annual reports, John Bogle's book on index investing is the best way to build wealth with real estate, with stocks, investing in an index. You can make more money investing in individual stocks, but it's like this. Let's say you can make 10%. Let's say you can make 10% investing in an index fund, doing absolutely nothing, scoring within the 97th percentile, right? And that's fine. Or you can make 14% if you use like a small little tweak to the system, which is what I put in my book, is the bucket system, the storage bucket system. So you boost your return by 3 or 4%. And then if you want to make more than that, then you need to spend an inordinate amount of time. So the time spent is literally like a hockey stick. So John Bogle is like a flat line, how much time you need to spend. My system with the storage fund is like this, and it gives you a little bit of a return. And then if you want to spend like this much time at the top, you can get much better returns, but that's your life. Those are like the full-time investors, like the Warren Buffetts, the Philip Fishers, and all the hardcore guys who are getting like the high double-digit, like 18, 19, 20% returns, the Carl Icahns and that's all they do, right? So I'm okay with the sort of the bottom of the hockey stick. So now my book, which is Financial Freedom Now, I'll tell you who that book is for. My book is for someone who doesn't understand what they don't know about money, because school doesn't teach them a lot of basic ground rule concepts about money, right? Lindahl and Bogle will not teach you about money, about how to understand money, where money comes from, how it's used, what the stock market represents. Like, they don't go into the basics. They go straight into it, into their specialties. I go to the basics. Then I go into how I designed a stock portfolio to grow and fund my growth account, and then how I went into real estate to pay my living expenses so I didn't need to work. So that's why it's called financial freedom, because my goal was to be wealthy enough to stop working sooner than later, because I wasn't interested in following my parents' path of working for 50 years. It's not what I wanted to do, right? So people who are not interested in working for 50 years, that's what my book is for. John Bogle's book, again, is about becoming wealthy through index funds. David Lindahl is becoming wealthy through apartment buildings. Mine is sort of a mishmash where I use index funds, individual stocks, and real estate investing to get rid of my job. Like I don't want to work anymore, or working is optional. So my book is for the person who's like, I'm not sure I want to do my job for 50 years. I want to have an exit. At least I want to know that there's an exit available sometime. Hopefully that makes sense. So this graph here, did I show this graph already? Yeah, I think I might have. This was interesting. Oh, I'm not going to show that because I don't know why the... So for real estate, let me see what else. What do I have here? Oh yeah, here are the areas that if you go to Adams Sales Data, it'll tell you. You can see here, so for counties that have less than 1 million people, you can see the best places to invest that have the highest rental yields right now in 2020 are Baltimore, Cumberland County, Bibb County, Mobile, Alabama. Surprised Atlanta's still there. Atlanta's been there forever. And the ones with over 1 million population, you can see actually Harris County, Houston, right? Dallas actually is there. Cook County, Illinois, and Wayne County in Detroit I mentioned. And Cleveland too, interesting. Cleveland's still on there. Thanks, Victoria. Yeah, my book, I thought the name was sort of, yeah, it's interesting. I don't know how to convey what I represent. Maybe I'll do that in my video, but I don't want to be so self-promoting. I just want to sort of like give out a lot, like 90% of my content is the knowledge that I learned over time through mistakes and hard learning. So, but for those who are curious, yes, my book is not like how to make money with this one asset class or how to make money with that one asset class. I read a lot of stuff, I made a lot of mistakes, and I learned a way to craft a system where I had an exit from work, so that work became optional and not mandatory. So I had a system that I crafted where I could get out, and I did. It took a little longer because, again, no internet, didn't know what I was doing, but I eventually got there anyway. So, Vishal, is there ATOM? Yeah, I know. Oh, this question always haunts me. Is there ATOM data equivalent for Canada? No. And the thing is, like, Canadian data is so terrible. So terrible. So, you know, Canadian system is literally you have to just call people. So I know a few commercial realtors that I keep in touch with, that they know me. You just have to call them and talk to them, and then you have to decipher the data yourself. It's just very difficult that way. So anyway, it's a little over 9 o'clock. I was going to cut it out at 9, but thanks you guys for tuning in. I normally, I never did lives on Instagram, but I'm doing them now because I used to do them on TikTok, but Live has a lot more features on Instagram where I can sort of show these graphs and this data, and that's kind of useful. TikTok, I can't do it as easily. So send me messages either on TikTok or on Instagram. I get back to them in either method. I think TikTok, I tend to do more videos to answer the question because that's easier for me. With Instagram, I got to use like these 2 thumbs, right? Really slow. I don't think they can do video answers. But any questions, throw me a message. I try and get back to everything. And that's about it. Looking forward to launching my book in a couple weeks. I was editing it and sort of doing some stuff today about it. It's I'll tell you a bit about the book in terms of its physical dimensions. It's going to be a book, again, I said, about money, stocks, real estate, and then tying everything together in terms of how the financially free put all those pieces together to craft a way to get out of the rat race. And it's about almost 300 pages. It's 300 pages. There's a lot of stuff. So some of the stuff that it covers, for example, when I bought individual stocks, what are the criteria I looked for? Where did I put emphasis when I studied individual stock? The U.S. index, why I think that's good and why I do that now. Real estate, turnkey investing, boots on the ground investing. What are the landlord-friendly states that I like to look at? What are the criteria I looked at on the financial side to make sure that the real estate investment makes sense and provide cash flow to supplement my income and then eventually replace my income. What 25 questions should I ask my property manager to make sure that the company that I picked is the right property management company for me? What are the 40 questions I need to ask or 30 questions I need to ask a turnkey provider to take care of my properties for me? How people spend money that's the wrong way versus the right way so that you're always making money and not just spending money and having to get back on that treadmill. The two different types of treadmill of the financially free versus the person who just works for money. And a whole bunch of other stuff in there. So that's what my book covers. It's almost 300 pages. I'm interested to see what it turns out because it looks good on Kindle Create. This is the caveat I have. The book looks good on Kindle Create. Like, I like how it looks, but I've been reading stuff online where the print version and Kindle Create don't necessarily translate as well. So I'm kind of scared to see what it looks like on the Kindle. I mean, the Kindle has a preview option, the Kindle Create. So it looks good to me on the Kindle Create. I wish it could do like subtitles. It can't do subtitles, which kind of sucks. It can only do general titles. So I only have, like, I can't go to a subtitle to read about, oh, Jim mentioned the criteria for evaluating a property. I want to go to that subsection. And it doesn't allow me to sort of jump there like that, which kind of sucks. So we'll see how it turns out. But it's 300 pages of goodness. I'm sure people who are new to the topic of money are going to need, which is what I did, to reread that thing over and over again, especially the subjects that you're interested in, because I had to reread a lot of stuff. It wasn't just the reading of it. It was just like I need to reread it because sometimes things went over my head and I had to like keep thinking about it for it to make sense. Hopefully I didn't write that badly. But there is a lot of information. Anyway, take care, guys. Have a good night, and we'll talk soon.